This tutorial is a project of nonprofitaccountingbasics.org, a free resource developed by the Greater Washington Society of CPAs Educational Foundation.
Hello and welcome. I'm Bess Foley, a nonprofit financial management consultant for small and mid-sized arts and human service organizations in the DC metropolitan area. This presentation is one of several sessions covering basic accrual concepts. In this session, we will focus on deferred revenue. But first, let's touch base on what accrual accounting means. Accrual accounting matches income and expenses in the appropriate fiscal period, regardless of the timing of cash inflows and cash outflows. Why would we want to do this? Well, aligning income and expenses helps organizations to understand their business model and determine whether certain activities have a surplus or how much they might need to be subsidized. This can be helpful in making a compelling case to funders. For example, you can only know that ticket sales and direct sponsorships cover just 55% of the cost to mount a theater production if you have aligned the relevant income and expense. Accrual accounting allows you to create a profit and loss for that program in the appropriate fiscal period. In addition, recording receivables when they are promised and payables when they are incurred gives you a more accurate and real-time picture of your organization's current financial position and its committed revenue and expenses. How do you do this? Balance sheet accrual accounts are used as temporary holding accounts until the time is right to move them to the P&L. These are the 6 basic accrual concepts. As mentioned, for this session, we are going to focus on deferred revenue. Simply put, when cash is received during one fiscal period, it may pertain to another subsequent fiscal period. In that case, we are deferring the revenue to the subsequent period. Deferred revenue is sometimes called unearned revenue. Deferred revenue is a cash payment your organization receives in advance for goods or services that have not yet been delivered or earned and that might need to be refunded if unfulfilled. Examples might include payments received in advance for next year's concert series or theater tickets, or payment of tuition for future classes or conferences or events that the organization is holding. Why would you defer this revenue? Well, it would be premature to show income before it is earned, especially if there is a possibility of having to make a refund. Recording income before it is earned is a little like counting your chickens before they've hatched. It also leads to less accurate interim financial statements. Income versus expenses may be over or understated since income will not necessarily align with expenses. So where does deferred revenue go? It lives on the balance sheet as a liability while waiting to be converted to earned income on the profit and loss, sort of like a parking lot. Using accrual accounting, these revenues are held in the deferred revenue balance sheet account. When the payment is received, cash is increased, the deferred revenue account is increased, and it is waiting to be recognized as revenue. The payments are not counted as income in the P&L until the service or goods are provided and the related activity takes place. In other words, when the income is actually earned. I'd like to point out that restricted income is not the same as deferred revenue. Another presentation covers the topic on restricted contributions. Here is a comparison showing what happens in cash accounting versus accrual accounting. In this sample, cash is received during period 1 for services or goods that won't be provided until period 2. In cash basis, you can see the income is in the wrong period. The cash was received in period 1, the income was for period 2, but in cash accounting, the income is counted right when the cash comes in. Using accrual, the revenue is parked in the deferred revenue balance sheet account when the cash is received in period 1. In that way, the income is recognized in period 2 by moving it out of deferred revenue. Cash is increased in period 1, deferred revenue is increased in period 1. In period 2, we decrease the deferred revenue and increase the income in the right period. Accrual allows the income to be recognized and recorded in the profit and loss in period 2 when the related activity or service actually occurred. If there is any chance that your organization would be liable to refund the cash if the service is not delivered, using accrual accounting to record it as deferred revenue until the income is earned is your safest bet. For you bookkeepers and accountants watching, here is the accounting flow for recording deferred revenue. When the cash is received, it is accomplished as any normal deposit. The cash is increased and the deferred revenue liability is increased. Both of those components, as we mentioned, are balance sheet accounts. When you've earned the revenue, you convert it from the liability to profit and loss income. That's accomplished by using an adjusting journal entry, and the deferred revenue liability is decreased and the income is increased. The income effectively is moved off the balance sheet and onto the P&L at the time the revenue is earned by delivery of the goods and services provided. To sum up, accrual accounting allows you to record income and expenses to appropriate fiscal periods, and it promotes a better understanding of your organization's business model and its financial position. For more information about this and other nonprofit accounting topics, visit our free online resource, nonprofitaccountingbasics.org. Thank you.